Ladies and gentlemen, good day and welcome to the Eveready Industries India Q2 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you, and over to you, sir.
Thank you. This is Nishit Solanki from CDR India. Good afternoon, everyone, and welcome to Eveready Industries India's Q2 FY26 earnings conference call. Today, we are joined by senior members of the management team, including Mr. Anirban Banerjee, CEO, Mr. Vivek Agarwal, Executive Director and Chief Financial Officer, and Mr. Anirban Ghosh, GM Finance and Head of Investor Relations. Before we commence, let me share a standard disclaimer. Some of the statements that may be made on today's conference call may be forward-looking in nature, and the actual results could vary from these forward-looking statements. A detailed communication in this regard is available in the earnings presentation that has been circulated to you earlier and also available on stock exchange websites. I would now like to invite Mr. Banerjee to share his perspectives with you. Thank you, and over to you, sir.
Thank you, Nishit. Good afternoon, everyone, and thank you for joining us on this earnings call for the second quarter of the present year. I trust you would have had the opportunity to review our results presentations. I shall focus my attention on the key performance perspectives. I will commence by sharing our view on the operating environment during the quarter. Consumer demand stayed resilient throughout the quarter, underpinned by robust services activity, even as discretionary spending remained mixed. Retail inflation was benign. Rural consumption continued to improve on the back of a good monsoon and stronger agri-linked indicators, with FMCG data showing rural-led momentum and small-town recovery. LME zinc prices were broadly range-bound during the quarter. At our end, we continued to hedge requirements in order to support momentum. With the rollout of GST2 reforms from 22nd September, the expectation is that prices reductions will unlock pent-up demand, particularly in Tier 2, Tier 3 cities, prompting more households to buy and upgrade. As far as Eveready is concerned, there is no change in the GST rate of our major products, except in our rechargeable batteries and solar segment. However, the trade channel witnessed some temporary disruptions in the month of September as the distributors transitioned to the new tax structures. Eveready continues to leverage its heritage of reliability while transforming into a more innovation-driven, consumer-centric organization. Our efforts over the past 2 years on distribution, product refresh, and digital engagement are now translating into sustainable growth. Our spends on A&P came in just above 10% for the quarter, which is in line with our aspiration. Typically, these come in higher during Q2, coinciding with seasonality. During the present quarter, we ran a very popular campaign during the T20 Asia Cup India-Pakistan cricket match, underlining the tempo we associate with targeted communication. Our Ultima Pro and Ultima range of alkaline batteries is performing extremely well, continuing to gain market share to 16.3%. Carbon zinc reported volume traction with market share rising to 55%. Flashlights continue with strong momentum realized in the rechargeable segment, while battery operated has seen a decline in line with the industry. The broad trend in lighting space remains moderate, although we are seeing underlying volume gains in most lighting subcategories. Our strategic levers, sharper channel segmentation, innovation pipeline in flashlights and lighting, and disciplined working capital management continue to underpin performance. Route to market operations are now mostly stabilized, ensuring better coverage and faster replenishment, while digital ordering platforms are improving visibility across distributors. I shall now turn my attention to segmental performance. Batteries. In the battery segment, we continue to build on the strong foundation and leadership position. Our carbon zinc portfolio sustained healthy growth in both value and volume terms, underpinned by our extensive distribution reach of nearly 4.5 million outlets and enduring brand equity. Importantly, our leadership position in carbon zinc with close to 59% market share remained intact and even showed incremental strengthening as the rural demand began to recover through the quarter. On the alkaline front, momentum has accelerated further. Q2 saw upwards of 60% growth. Having grown market share to 15.3 in Q1, we saw nearly 100 bps of expansion in Q2 to 16.3%, aided by sustained consumer awareness campaigns for our Ultima range, product availability across modern and quick commerce platforms, and a rising shift towards higher drain devices. Our Jammu Greenfield facility, which remains on schedule for completion by the end of FY26, will provide a further flip to the robust alkaline demand trajectory. From a raw material standpoint, zinc prices showed some firmness during the quarter on year-to-year basis, which we were able to mitigate. With disciplined cost management and an optimized product mix, we have been able to absorb commodity volatility while still delivering profitable growth. Flashlights. In our flashlight segment, directionally we maintain trajectory. However, there was some moderation in momentum in the quarter owing to lower offtakes in the battery-operated segment. Rechargeable flashlights once again delivered double-digit growth with gain in volumes and premiumization-driven sales mix. Demand in this category was supported by broader acceptance in modern trade and institutional channels, where the value proposition of durability and convenience has resonated strongly. Our strategy of introducing feature-rich models has further strengthened our position as consumers increasingly prefer premium rechargeable formats. Battery-operated flashlights showed lower traction with volume decline in the quarter. This reflects the natural shift of consumer preference towards rechargeables, which we view positively as it allows us to consolidate share in the fast-growing segment. Importantly, our presence across Tier 2, Tier 3 and rural markets has ensured that the transition is managed smoothly with distribution muscle allowing us to push the upgraded portfolio effectively. The implementation of the mandatory BIS certification regime is expected to add further tailwinds. With larger organized players already in compliance and medium to smaller unorganized players required to transition by year-end, we expect further consolidation in favor of branded offerings like ours. Lighting. In the LED lighting business, we delivered healthy volume growth across key subcategories such as batten, panels, emergency lamps, and luminaires. Consumer adoption of adjacent products like small electrical accessories introduced recently have also gained traction, validating our strategy of leveraging the Eveready brand across complementary household electrical categories. In the professional lighting space, we continue to work towards deepening relationships with institutional buyers and project clients in the public sector space. Demand is building up in customized luminaires and panel lighting, where our ability to offer reliable quality and cost competitiveness has started to gain significance. This segment will remain a focus area for us as infrastructure and commercial investments expand. We remain cognizant of the structural value erosion in the LED category, driven by persistent price compression across the industry. The quarter clocked a 10.6% total revenue growth while delivering a robust volume growth. We continue to work on product differentiation, efficiency in sourcing, and disciplined working capital management. Now, I shall proceed with the financial highlights. We have seen revenue growth in battery and lighting categories, while a minor degrowth in flashlights for the quarter. The company quarter growth is reported at 6.7%, backed by stable gross margins across segments. Company EBITDA margins stood healthy at 12.7%, reflecting strong underlying operating performance. Your company recognized a charge of INR 15 crores during the quarter in lieu of settlement with the claimant in a long-drawn arbitration proceeding against the company, in which the company has now received a consent award, withdrawing and terminating the arbitration proceeding in favor of the company. Your company also incurred the cost for strategic non-recurring ex gratia payment to workmen of INR 22.7 crores for separation. As a result of this, the PAT stood at minus INR 7.9 crore. Our robust distribution network of over 4.5 million outlets and strengthened digital RTM backbone continue to enhance market reach and channel efficiency. Prudent working capital discipline and low leverage with a debt equity ratio of around 0.7 reflect our strong balance sheet position and ability to fund growth internally. In essence, the quarter reflects disciplined execution, operational stability, and steady progress across our key businesses, reaffirming the strength and the resilience of the Eveready franchise. Our continued focus on innovation, efficiency, and consumer engagement positions us strongly to navigate opportunities and deliver steady, profitable growth. With that, I would like to hand over to the moderator to continue the proceedings and invite questions from the participants.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arnav Sakhuja from Ambit Capital. Please go ahead.
Hi. Thank you for taking my question. So, over the last 2 quarters, correct me if I'm wrong, but the total ex gratia non-recurring payment that has been incurred is around 29 crores. So are we expecting any more payments for this in the next couple of quarters, or is it completed?
So, this is Vivek Agarwal, CFO. So, we are very cautiously going for that. As you are saying, this is strategy. So at this moment, it looks like for the next 2 quarters, we don't see anything coming up right now. But if we see some opportunities there, then we can look for. But apparently, there is nothing on the plate at this point.
And could you give a bit more detail into this payment? Like, what exactly is it for?
Arnav, your voice is breaking actually, not clearly audible to us. If you can pick up the handset.
Is this better?
Much better.
Yeah, sure. So my question was, if you could just give a little more detail into what exactly this payment is for.
Yes. So actually, as you know that we are a legacy organization. We have multiple factories locations. So now we are looking for that because of the change in the demand of the zinc batteries, and we have the upcoming alkaline factories in Jammu. We are also realigning our manufacturing capacities. We are trying to see where we have the legacy worker. Can we consolidate some of the manufacturing at one location? And because of that, 2 locations, one majorly for our Noida locations, we have done the separation of 150 workers, and around 10 workers we have done from our Kolkata plant. So this is purely to reduce the inefficiency and overburden cost structure.
And so I just have one more question. So with regards to the arbitration proceedings, so we recognized a 15 crore payment this quarter. So now, I mean, does that mean that the case is over and we have no restrictions on capital raise and, I mean, all the other restrictions that we had earlier?
Yes, you are right. You're ready. So we have got the arbitration order on the 1st of October, which you have duly filed exchange, that we have been now relieved from the list of the parties. So for us, Eveready now free from handling our own assets, managing our capital structure, so there is no embargo.
And there's no other payment required for the arbitration, right? It's complete.
Yes, it's complete.
Okay. Thank you for answering my questions.
Thank you, Arnav.
Thank you. A reminder to all the participants, you may press star and one to ask a question. Ladies and gentlemen, in order to ensure that the management will be able to address all the questions from the participants in the conference call, we request you to kindly limit your questions to per participant. Should you have a follow-up question, please rejoin the queue again. The next question comes from the line of Vikas Srivastav from RBC Financial. Please go ahead.
Yeah, thank you. My first question was, I just heard 2 things. The previous question, number 1, that you will grow with enough funding for internal funding for growth. The other thing I heard was that the Noida factory, you reduced 150 employees. My question is, therefore, are we in the process? Is the Noida factory still operational? Are there more workers there? Or, I've been asking this question for the last 2 quarters. With so many factories and the alkaline factory going to Jammu, are we in the near future thinking of selling some properties, specifically the Noida factory? And have we had any internal assessment of what we'll sell and what is the market value? That's my first question.
Thank you, Vikasji, and I really vouch that last 2 quarters you are keep asking this question. So, first of all, that any capital structure, any relooking is only possible after the embargo is over, right? So, thankfully, we have taken, as a management, as a board, has taken a very prudent decision to settle with the realtor who was the claimant, and we are now out of this. And as I told to the previous person that now we are looking into realignment of our manufacturing capacity, because as a management we are committed that not we will let any inefficiencies to build up, and that is the strategy for us. Let's first, for anything you want to do, first you have to understand that you are cost neutral, cost zero. So we have done it. Maybe matter of couple of quarters, 1 or 2 quarters, you will get an update from us. We are in the process of just consolidating, because we have a multiple size of batteries, whether AA, AAA, metal jackets, plastic packs. So these are a lot of things. So we have already started, and this is the testimonial for this. At least those are ideal costs. Let's get those some costs, let's remove. And probably our next activity, what I said, that we have to work to ensure that we do right alignment of our manufacturing assets. And if we found something surplus, definitely we'll come to you.
Okay, thank you. My second question was that, with our, the costs these one-time costs we have paid specifically on the extra share, that is one, this thing, that should give us some kicker on the EBITDA going forward. We should, with the BIS and implementation, which I hear should happen from the first part of the calendar year, that should give a fillip on sales as well as EBITDA. And the third is the alkaline battery in Jammu plant. Any general guideline in terms of what we as shareholders can expect in this financial year in terms of growth and 2-3 year perspective in terms of growth? And I'm not talking about inorganic growth, I'm talking about organic growth here.
So, sir, a good point. I think 3 points you have touched upon that. Of course, if we have settled the Noida worker upcoming time, this will be giving us some benefit. Of course, it will give us some benefit. Coming to BIS on flashlight, we can only see the benefits because, as you know, we are largely unorganized in this part. So the January 26 is the time where the time cooling period ends. When our season starts from April next year. So we are keeping finger crossed that this should have a positive, and that is why Anirban in his speech has really highlighted that it will definitely, the consolidation will go in favor of branded player. Third, that coming to that our alkaline factory, as we are committed that it will come at the end of the financial year. We are on track at this point of time. We are monitoring our progress in terms of the construction, in terms of the installations very regularly. So this is on track at this point of time. Only thing I can say that as your company, if you see last 4 quarters, we have shown continuously steady growth. There are a lot of things keep coming. In the month of September, you have seen a 1 trillion has come. While our cases, there is no GST change, but the market sentiment has got changed. Despite we have grew 6.7%, we are all poised to ensure, because in FMCG company, one of the important levers to grow. So we are keeping all antennas up to grow. And so only I can say the testimonial is in front of you. We are growing profitable, we are growing cash flow rich, and also we are growing revenue momentum. Anirban, if you would like to add anything in this.
So I think H1 directionally sets the tone for our H2 as well. As Vivek rightly said, that while September had no impact on our categories per se, but the general confusion in the trade, stopped our momentum a little bit in the month of September. But that being said, in spite of that, I think between Q1 and Q2, we've fared reasonably as planned. And our estimate is that even the second half of the year should be as buoyant as the first half of the year. Thanks.
So when you say buoyant, we are talking about a 6%, 7% growth year on year for the second half. Is that your definition of buoyancy?
Because, as you know that the 6-7% growth are what we are maintaining. At this point of time, at least as a management, we should be looking forward that type of percentage growth. And that is the way we are working out. That at least, because if we don't give, and the commodity prices, as you know, metal prices are on the top at this point of time. Forex is on the top of the price. Because then it will be very difficult for us to maintain the sustained profitability. Because if you see, we are, despite of the dollar has gone up and the zinc has gone up, we are ensuring that at least that the bottom line, the judicious cost management is going up. So as we say that, at least it should be there towards the first half, and second half should be in line with that.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good evening, team, and thank you for the opportunity. Now that the alkaline factory is likely to kickstart maybe by the start of the next financial year, any sort of sense in terms of what is the plan to break even, or what could be the capacity utilization in the first and the second year, which you would have worked out?
So, sir, currently if you see that, we have taken a very bold call and we have gone for 360 million capacity plant, right? AA and AAA put together. Currently we are sitting around 60-65 million numbers. We are very hopeful that, next year we'll have a good growth. If you see last 2 years, we are doing almost 50% plus growth in this category. And while the carbon zinc as a volume is very flat to marginal growth, but this category is showing a very high, strong double-digit growth. So first of all, we are very confident that, of course, there will be a substantial jump in the next year volume. And second, in terms when we do the local manufacturing, we get some edge. So that will also add to our momentum, growth momentum.
So right now, is it fair to say that the margins in alkaline will be lesser versus the carbon zinc? And by when can the margins for alkaline be at par with carbon zinc? At what utilization levels on an approximate basis?
Sir, your observation is right at this point. Yes, the alkaline margins are lower than that. And, both products have their own way of working. We would love to get alkaline better margin, but at this point that how do we do inch by inch up? So first our local manufacturing will give us some boost, and still may not be same as that, but in the next 2 to 3 years, because today we are not market leader as we are in zinc. We have in the last 8 quarters got substantial market share from a low single digit to now 16.3%. And our continuous effort through our marketing, through our deep-rooted penetration on our distribution. So the consumer is looking into that. So at this point of time, I think at least 2 to 3 years, time frame will require at least to get a very sizable gross margin and respectable gross margin in this particular alkaline category.
In terms of flashlights, the mix of rechargeable is at about 57 odd %. Now that BIS is getting paid out next year, is it fair to say that this can maybe in the next 2 years become almost 80-85%? And are margins in rechargeable better versus say battery operated?
So our current, if you look at the end of H1, both of them will be close to about half, right? 51-49 kind of a situation. Yeah. And you're right. I mean, the rechargeables are poised to grow. And you're also right that as, when the BIS comes through with the smaller operators, essentially the cost of compliance of hopefully a lot of the fundamental small operators should go up, reducing the price cap which are offered to the market for, some of the more quality, credible products, like the Eveready brand. And that should kind of propel the category further. Now, that being said, the rechargeables today are, yes, a shade lower in their margin structures than, the battery operated. But with the implementation of BIS, some of these, the battery operated also should possibly not reduce as much as it should be, because a lot of the unorganized sector will then try to move towards the organized sector. And it could be in both fashions. So even out there in the market, while in the battery operated more than, 75% would be branded play, there would be a good to 25 to 30% unbranded play. A part of it would also move towards the branded side. But you're right, there will be acceleration in the rechargeable portfolio, and that should see us having a slide towards rechargeable maybe at a sort of a 60-40 level, but I don't see that, any one of them sliding exceptionally ahead of the other.
And lastly, sir, if you look at our P&L optics, gross margins are at close to 5% and EBITDA margins is about 10%. So there is a significant fixed cost kind of an element which is as of now in play. Now that we've taken a lot of steps in the last 2-3 years to accelerate revenue growth, maybe next year could be the year where we could see strong double-digit revenue growth. Is it fair to assume that once the revenue growth is into the double-digit territory, there could be benefits of operating leverage, or you think you will invest in ad spend and neutralize that?
So the sense is that, yes, you're absolutely right. I mean, at the structures of fixed costs that we are, we are quite solidified for, garnering revenues for the next 2-3 years. And thus, logically, it should, as a percentage, move down as the scale goes up. Now, that being said, there could be opportunities of acceleration that we might look into from investments, maybe in different technologies or channel bifurcations that are coming up from a new trend point of view, right? But at an overall level, we will at least keep it steady or healthier.
Great, sir. Thank you for your thoughts and all the very best.
Thank you.
Thank you. The next question is from the line of Slade Alexander from Artha India Ventures. Please go ahead.
Yeah, good evening. Can you hear me fine?
Yes, please.
Okay. So I just had a couple of questions following up on what was already discussed earlier, but if you all could please elaborate. So firstly, with regards to the cost of goods sold and the revenue, my observation is that the costs have been rising roughly about, the rate is like twice as much as the revenue. So the revenue seems to be a bit slower and the costs are going up higher and higher, both quarter on quarter and year on year basis this time. So can you please tell me how are you all planning to manage these costs, whatever it may be, input cost, inflation? So are you all planning on passing it on to the customers or keeping it low so that you all don't lose the market share, or how will you all be tackling this so as to maintain the margins? That is the first one. And second one was just a follow up on the any fundraising plans like a rights issue or anything now that the issue that was there with Real Touch has been resolved. And these are my two questions. Thank you.
Thank you. So I think what you were talking about, in terms of margins, definitely if we see something, abnormal price increase, cost increase in terms of like our major raw materials, zinc or EMDs or we see forex, definitely objective would be to recover from the market first, pass on, because these are uncontrollable costs. But all the time in MRP driven market, which is hyper competitive, is not possible. So we use tactically. You see where our strengths are in the market, and if there's an opportunity, definitely we go for a price rise. Or one of the cases, if you see we are a hyper competitive, then we also look for how do you leverage our cost, how do you do a most cost competitive. And that is why you see, despite the material prices has moved to a very high rocket place and the forex has gone up, still our operating margins levels we are holding very steady at a 13% level. So that is a very strong thing we are doing. And if you see, with respect to the fundraising, at this point of time, we are not considering anything. But you are right. Now we don't have any barrier, we don't have any embargo. If we require fund, now we can look for that in future.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Priyankar Sarkar from Square 64 Capital Advisors LLP. Please go ahead.
Hi, good evening, sir. Sir, a couple of questions. So on slide 20, you have put some photos of some extension cord, zap tape, there's Everflow Wave, all of these. So just wanted to understand, when did we launch these products? And the second follow-up to this is that, are we adding more such SKUs to our lighting portfolio?
So, thank you, Priyankar. So that is these are accessories what Anirban has spoken in his thing. Because anyway, you are going to lighting EOD category, right? And so it makes sense for us whenever we find a right opportunity which gives us a scale to EOD and also to the GT channels. Because we have a sizable general trade, right? Because there is a price point matters. So this has been launched 2 quarters back. And very good response from the market, because as an Eveready, the quality, we are upholding the quality parameter.
Okay. And sir, how many outlets have we reached in the electrical outlets channel?
So, so we would be close to about 25 to 30,000 outlets as far as our electrical channel is concerned. Now, interestingly, I think the only point that I would want to add is that we are one of those unique organizations which run electrical channel and have a very vast general trade presence as well. And a significant portion of the general trade in today's India also does carry some of the elementary lighting products, as the trade has opened up over a period of time. So thus, in combination, when, we say that, we have lighting products, those will be an addition of our general trade and our EOD channel both together, which will be significantly higher than only the EOD channel, where we have a retail presence of somewhere between 25 to 30,000 outlets.
And sir, if I may ask, what was it a year back, this outlet of 30,000, 25 to 30,000?
But we typically would be half of that, right? So
we have doubled basically over the last 1 year.
Yes. So, so the outlet, there are many dimensions to it. I'm putting it very simply, but typically dimensions of outlets are that, are you billing them once in a month or once in 3 months or once in 6 months? But if you were to take a once in 6 months kind of a view, we would have typically doubled it.
Right, sir. Okay, sir. Thank you very much and wish you all the very best.
Thanks.
Thank you. The next question is from the line of Vipul Shah from RW Equity. Please go ahead.
So my first question is with respect to the, separation cost which we've incurred this quarter, which was a one-time cost, as you mentioned. What is the recurring benefit going forward, which we will receive as a company?
So if I have to say that what is the payback of that, which directly gives you between the 4 to 5 years of a payback of this expenses there. So that is where, if you can see 1/4 is definitely going to come back to the company every year.
Got it. And secondly, sir, if I may, as a company, we've been sort of incurring a cost towards payment of commission to non-executive, non-independent director, who is sort of the promoter's representative. And rightfully so, he's sort of various other, big promoter group companies also he's fairly involved. But just wanted to, ask one question as to what is the sort of benefit he brings to Eveready, which otherwise the company cannot avail. And isn't it sort of a low-hanging fruit in terms of, also, it's a sizable amount of 2 crores plus per year, which, the company is incurring. So, isn't it worthwhile for the company to review this arrangement? It may work well for the promoter. There is no doubt on it. But if we are able to sort of rationalize even, as we are rationalizing a lot of excess manpower as the company is rightfully doing, is this something also which is there right now in the domain of the company?
So point well noted, sir. But at a leadership level, the visionary guidance the person bring on the table is very, very useful, impactful. He has a ground and he is the person who was involved from the day one. So to run the company in a typical...
Point is taken, sir, that he was involved in the day, when this whole takeover was, there, and as we understand, it is the promoter's representative. So obviously, it is also the promoter's, and the fact is the market really values the promoter very highly. So it is quite, I would say, unbecoming sort of exercise here, where I'm not even at once doubting the credibility or this, but as a non-executive director, he also is entitled to various sitting fees which the company anyways pays to all the other non-executive directors. So rightfully, a lot of them also bring very valuable insights to the company, being sitting on the board. I think there is a conversation which the company needs to have with the promoters as well. Now that formally one of the members of the promoter group is also being inducted on the board. That is my humble request, sir.
The first point I said it is well noted. I was just telling that, the even after the takeover, first after 1 year, each quarter we have a lot of problem after the RTM and the GTM exercise has been done. Now we see some stability is coming up. And the person is really straightway working with us to help us how do we navigate through. But as you have pointed said, your point is well noted and we'll look into that.
Thank you so much.
Thank you. A reminder to all the participants, please limit your questions to per participant. The next question comes from the line of Mithun Ashwath from Kiva Advisors. Please go ahead.
Yeah, good evening, sir. Just wanted to understand now that this case is also behind you and you are able to raise further funds, would you also plan to look at entering other adjacencies or any new categories, which was something that I think at the point of where, the new management came in, they have been talking about this in terms of entering new categories where the market size could be quite high so that you were able to grow the revenues of the company. Just wanted your thoughts on that.
Yeah, thanks for the question. I think for any organization, including us, going forward, there will be positions that we look into for leveraging our brand across synergistic, complementary, categories, which are in essence connected to the brand and to the channels that we dominate and service. So that is something that we will continue to look into, and eventually there will come a time that post some experimentation, consumer connects, research and pilots, we go whole hog. So to answer your question, yes, in the future we will look into various kinds of categories. I hope that answers. Okay.
Is there any timeline for that one?
So it is a bit dynamic, but we will look into it from a year-to-year perspective. Last year we moved into a very small category called mosquito rackets, and in this year we are scaling up mosquito rackets quite fast. Some of our, if you've seen some of the electrical side of the business, while we were focusing on various kinds of lights and emergency lights, etc., we've been also this year pushing hard on some of the electrical accessories, including tapes, and wherever there are commonalities between general trade and EOD. So we are also at a time strengthening the core while we are doing that, and anywhere in a 12 to 18 month period, we will be pushing in other categories as well into the market.
Sure. Thank you.
Thank you.
Thank you. A reminder to all the participants, please limit your questions to per participant in the initial round in order to give fair chance to the other members in the queue. The next question is from the line of Saket Kapoor from Kapoor Co. Please go ahead.
Yeah, namaskar, sir, and thank you for this opportunity. I hope I'm audible, sir.
Yes, Saket.
Yeah. Sir, I missed your opening remarks. So now with the embargo being cleared with respect to the legacy issues, and we will be now in a better position to rationalize and utilize our assets, selling of non-core assets. So these activities is what we can expect going ahead with respect to the roadmap for more profitable growth and leveraging the facility. That should be the key strategy other than the greenfield asset which we are envisaging to operationalize. These are the two areas where we think we will be working going ahead.
Very fair expectation, Saketji. I think you missed it. So because we asked this question and I explained in detail, so that removal and the one-time separation of the worker is also a journey towards removing inefficiency and from our structure. We have said that right now we started realigning our manufacturing capacities in view, especially upcoming alkaline facility and the way zinc trends are going on. So your expectation is very fair that, as we have done this separation, so benefit will start accruing in our financials in the financial upcoming time. So that's the way we are looking for that now going forward as the embargo is over. How do you realign our manufacturing facilities?
Okay. And sir, in terms of the Jammu facility, I think so last when we interacted, we were awaiting for some clearances from the government in terms of the duty package rebate that has just expired. So do we have any further updates in terms of the same?
Unfortunately, Saketji, there is no movement on that. So what we understand, government, they are mulling over to increase the package, but there is still the time this is announced. It is only in conversation. So we are working with the government very closely to ensure that at least industry, those that have been there, they get a fair chance, fair benefits. Dialogues are on, but as this benefit, there is no such announcement has come.
Okay. And what is our long stop date, sir? When can be commissioned with respect to the development there at Jammu? Yeah.
So we are expecting by the financial year end, our commissioning should have been completed.
Okay. And lastly, sir, taking into account all the route to market initiative, improvement in margins, and other steps which have been taken over a period of time, and with H1 performance and now GST rationalization, all factoring in, how are we looking H2, specifically keeping in mind the seasonality impact also? How do you think H2 will shape up comparison to the last fiscal?
So, sir, our seasonality, as you know, the first half of the year is a heavy season for us, right? Because battery flashlight is basically monsoon, summer, that type comes. But however, we are holding that we should deliver, we should do at least same or better than the H1. That is the way we are looking into. Internal management team is working very hard to deliver good results. But, sometimes like one-off things keep coming like GST rationalization, whereby our cases there is no GST rate change has happened. But the market sentiment got some bit of momentum, but that is picking up in October. So hopefully we'll have the good next 2 quarters.
And margins also we are able to maintain. That should also be the...
the later quarter 3 and quarter 4 margins are little bit diluted because of, as I said, season is at the very beginning, quarter 1 and quarter 2. But we will try to hold closer to the margins.
Right. I'll join the queue, sir, and all the best to the team, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Vikas Srivastava from RBC Financial. Please go ahead.
Yeah, I just 2 questions. One, of course, is if there's an update on the CCI penalty and what is the next date, and what are our expectations, if we have any, in terms of the liability there. The second question really was a follow-up on the previous question. In terms of promoters, nominee director being paid, consideration of 2 crores a year. The fact remains that we are now accepting that the route to market has stabilized. The company, we paid Bain and Company a large fees. We are shareholders for a long time. The promoters have a stake in the company in any case. I would just endorse that statement that maybe this is the right time to stop this payment, and maybe you can give us an update or at least convey this to the board for future. The second was on the auditors. You have the same auditor which was there with the old promoter, and both in terms of getting institutional investment, more coverage, more financial coverage, it may be a good idea to get one of the big 4 as auditors going forward. Has it ever been under consideration?
So you have asked 3 questions, so let me give you one by one. So CCI, our next date to my decision, 19th and 20th of November. It could be 18th, 19th or 19th November, this month only. So the hearing is there. And as of now, as our position we are maintaining, there is no quantification of liability from our side. And that is the way continuously, if you say the part of notes account we are maintaining at this point of time, it will be very difficult to say what would be the estimate of that. And so that is the first position. With respect to the commission, I have explained my position to the previous speaker as saying that, my thing. But however, I take a note of this point. And with respect to auditors, so I think a year back the auditor has been given a reappointment. But as you are saying that looking into the Big 4 and all, that is the point. But when you have given the extension to the auditor, a lot of things have been looked into, and we find the way of working is good. But anyway, there are 3 years left out. They will not get rollover now. So we'll look into that. So now we have given them extension, the second year going on for them. So this is the second year. So point well noted, Vikasji.
Thank you.
Thank you very much. Ladies and gentlemen, as there are no further participants, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for taking time out to join us on this call today. I hope we've adequately answered all your questions. If you still have more queries, please do reach out to our investor relations team, and we will be happy to address those. Look forward to connecting with you again in the next quarter. Thank you.
On behalf of Eveready Industries India, that concludes this conference. Thank you for joining us today, and you may now disconnect your lines.